Hello and welcome to Session 3 of the Basic Tax course. We're going to begin Session 3 with a review of the Session 1 answer key. And before we move on, I wanted to remind you that you can access the Session 1 quiz answer key from inside the materials page for Session 3. You might be a little bit confused that the Session 1 quiz answer key is inside Session 3, and the reason for that is that Session 3 is when we actually review the quiz, and we don't want you to be reviewing the quiz answer key or have access to the answer key until you've actually completed the test in Session 2. So you should have Pub 17 open. You should have the quiz answer key open in front of you. If you haven't already printed the answer key, you can at this point push pause on video playback, print it, and come back. Or if you're all ready to go, let's get started. Beginning with question number 1. John, age 50, is single and a citizen of the United States living in Canada. In which of the following circumstances must John file a tax return? Number 1, or A, John's income is $9,500. Number B, John is not required to file because he did not live in the United States. Or C, John's income is $9,550, or maybe more than one of the above, as in A and C both. It happens to be that D, both A and C, is the correct answer. And how do you figure that? Well, you look at the filing requirements for a single person. And let's just go to Table 1.1 in Pub 17, which is on page 4 of Pub 17. And I'm just going to scroll till we get to this particular table and then zoom in on it. And we can see that the filing requirement for a single person under the age of 65 is $9,500. You are required to file a tax return if your gross income is at least $9,500. Well, if we look at question number 1, A is $9,500. That means 95 is at least 95, isn't it? And question number C, $9,550 is, well, more than $9,500, so definitely required to file with that one as well. The only one in here that is a false answer is John is not required to file because he did not live in the United States. It's a completely bogus statement, absolutely untrue. Although a lot of people think that. They live overseas, they're filing tax returns in a foreign country, they feel more closely connected with the foreign country. What does their U.S. citizenship have to do with anything when they're not in the United States? Well, as far as the IRS tax code is concerned, U.S. citizenship has to do everything with filing requirement. And if you are a U.S. citizen, regardless of where you are living in the world, if you meet the filing requirements spelled out in tables 1.1, 1.2, or 1.3 of Pub 17, you're required to file a return. Number 2, Jack, age 62, is married to Betty, age 61. Betty is legally blind. Jack and Betty are required to file a federal tax return in which of the following situations? A, B, C, or both A and B. And we're looking at how much their income is and then carrying that over to the table. Well, Jack, age 62, is married to Betty, age 61. Betty is legally blind. Neither of them are age 62 or older, so we're simply going to go over to married filing joint where both are under age 62, and the filing requirement is $19,000. So if their income is $20,150, they're required to file. If their income is $19,000, they're required to file, and that's why both A and B are the correct answers. But their joint income is only $17,000, they wouldn't be required to file. Now, this legally blind issue with Betty, you might think, or that should push up her filing requirement, but the blindness factor for a taxpayer who is not a dependent, the blindness does not factor into their filing requirement. In other words, that additional standard deduction they are given for being blind does not increase the amount of income they are allowed to earn before they are required to file. Blindness only increases the amount of income that you may have before you are required to file if you are a dependent, as the rules in Table 1.2 show. Number 3, Sally is self-employed and did not receive Form 1099 miscellaneous. Gross receipts for her business were $5,000. The net profit for her business was $350. Sally is required to file a tax return. And the answer is technically false. And let's see why the answer is false by going to Table 1.3. It says on line 3, or item number 3 of Table 1.3, You are required to file a tax return if you had net earnings from self-employment of at least $400. Well, the wording of the problem says that the net earnings from self-employment is $350. That's less than $400. So technically speaking, Sally is not required to file. However, I can tell you from my experience as a tax professional that the issuance of a 1099 miscellaneous to Sally with $5,000 of non-employee compensation showing on it, she's going to get a letter from the IRS saying that she owes money, or that she's required to submit a letter explaining why she doesn't need to file, or they're going to tell her she has to file to prove that her net earnings are only $350. So if you come across a question like this in an exam, you get right down into the technicalities of it. Table 1.3 says if your net earnings are less than $400, you're not required to file. Her net earnings are less than $400, so that is why we say the answer is false. Number 4, Jenny is a dependent of her parents. She worked part-time over summer vacation and earned $4,500. Jenny also has investment income of $600. She is required to file a federal tax return. And the answer to that is true. Essentially, we are allowed to figure her standard deduction, and if her income is greater than her standard deduction, she is required to file. Her standard deduction is figured by taking her earned income up to $5,500 and adding $300. In this case, her earned income is $4,500. $4,500 plus $300 is less than her income of $4,500 plus $600. She is therefore required to file a return, and the answer is true. Number 5, interest and dividend income can be reported on Form 1040-EZ. I don't think so. Interest income can be reported on 1040-EZ, but dividend income cannot be reported on 1040-EZ. Let's open up 1040-EZ and just take a look at what I mean. So I have 1040-EZ up on the screen in front of you, and you will see that 1040-EZ on line 1 provides space for wages, salaries, and tips. On line 2, it provides space for taxable interest. On line C, on line 3, it provides space for unemployment, and that's it. You're not going to be able to enter dividend income onto Form 1040-EZ. If you have dividend income, you're going to have to move up to 1040-A or the full Form 1040. Let me open up 1040-A for you real quick. Here is Form 1040-A. We have space for more types of income on this form. Line 7, wages, salaries, tips. Line 8, taxable and non-taxable interest. Line 9, ordinary dividends and qualified dividends. Line 10, capital gains, distributions. Line 11, IRA distributions. Line 12, pension and annuity distributions. Line 13, unemployment and Alaska permanent dividend funds. And line 14, Social Security benefits. So Form 1040-A is a short form, and it does provide space for reporting dividend income. However, according to this question is not asking whether or not interest and dividends can be reported on 1040-A. The question is, can they be reported on 1040-EZ? And the answer is interest, yes, dividends, no. So if it's a plural or a multi-item question, interest and dividend can be reported on 1040-EZ? The answer is no, false. 1040-A or 1040 only. Line 6. You can use Form 1040-A to report which of the following sources of income: interest and dividends, capital gains, unemployment, pension, A, C, and D, or F, all of the above. Well, this is what I like to call one of my questions. It's an April question. You would never get a question like this on a state or federal exam because they never have really more than 4 choices anyway, and I've given you, 6 here? But I wanted to make you think really hard when you're coming up with the answer here. So 1040-A, I just showed it to you. What kinds of income can we report on that? Can we report interest and dividends on there? Yes, we can. Can we report capital gains? Actually, we can't. We can report capital gain distributions, but a capital gain distribution is different than capital gains. In fact, capital gain distributions are reported on Form 1099-DIV. And we are going to be covering Form 1099-DIV in Session 3 today. We also have unemployment, and unemployment can be reported on 1040A as well as pension income. So the correct answer is A, C, and D. The capital gain income requires long form 1040 and cannot be reported on 1040EZ. Number 7, Jessica has a balance due on her federal tax return of $500. She cannot afford to pay her balance due. Jessica decides to file an extension so she can save enough money to pay her balance due by October 15th. Which of the following statements is true? Jessica can mail her tax return and her balance due on or before October 15th without being charged a late payment penalty? I don't think so. Number B, Jessica will be assessed interest against her balance due beginning on April 17th. Well, we're studying 2011 tax law, and if you've paid attention, the filing deadline for 2011 returns was April 17th, 2012. And if you have not paid your balance due by April 17, interest does begin to accrue on that date. So B is a correct answer. And C, since Jessica is filing an extension, she will not be assessed late filing or payment penalties. That's simply not correct information. Both the C and A are false statements. And if we flip over to the quiz answer key for session 1, you'll note I've put a little bit more time in here, or a little bit more information on here, and also, so just flipping to the answer key, here's question number 7. B is the correct answer. The extension of time to file does not give an extension of time to pay, and Jessica must pay her balance due by April 17th, or she will be required to make or pay a late payment penalty. Number 8, Sam is a U.S. citizen serving in the Army. He was stationed in Guam on April 17th. Sam's income was $9,000. Which of the following statements is true? We offer you a number of different options. Ultimately, D is the correct answer. Sam has until June 15 to file his U.S. tax return, but he will be assessed interest on any balance due beginning on April 17th. The reference for that is Pub 17, page 10. And if we go to the column, bottom of the middle column on page 10 of Pub 17, you will see it says individuals outside of the United States. You are allowed an automatic 2-month extension until June 15, 2012 if you use the calendar year to file your 2011 return and pay any federal income tax due if you are a U.S. citizen or resident and on the due date of your return you are living outside of the United States and Puerto Rico, and your main place of business or post of duty is outside of the United States and Puerto Rico, or you are in the military or naval service on duty outside of the United States and Puerto Rico. And then it has it right here. However, if you pay the tax due after the regular due date, which is generally April 15th, interest will be charged from that day until the date the tax is paid. So you're not going to be charged, or Sam will not be charged a late payment penalty or a late filing penalty, but he will be charged interest on any balance due that he owes. And the interest is assessed on the period between April 17th and June 15th, or earlier, whichever date he files and actually pays. Number 9, Bob, age 28, is a resident of the United States. Bob's wife, age 25, and children, ages 3 and 4, are residents of Canada. Bob's wife does not have any income of her own. Bob sends money to Canada to support his wife and children. Bob will file a joint return with his wife. What is the minimum income level at which Bob must file a U.S. tax return? And we get $3,700 as being the correct answer. And to see why, we need to go back in Pub 17 to page 4 and go back to this table that we've already spent a lot of time staring at. You will see that one of the options for married filing jointly is filing requirements of $19,000. And so how do we have a filing requirement next to married filing joint of $19,000, but then say Bob, who's filing a joint return, must file when his income hits $3,700? Well, if you look at the table, it has these 3 little asterisks next to married filing joint. They guide you to the bottom of the page, and I've highlighted down here what it is that I'm reading from. If you did not live with your spouse at the end of 2011 or on the date your spouse died, and your gross income was at least $3,700, you must file a tax return regardless of your age. So that is where we got the answer to question number 9, $3,700. Number 10, In which of the following situations should you file a return even if you are not required to file? And the answer is D, all of the above, but let's look at what the options were. If you had income tax withheld from your pay, if you qualify for the earned income credit, or if you qualify for the additional child tax credit. Well, all of those are fairly much no-brainers. If the government owes you money, you should file a return. And for a complete list of reasons you should file, flip to Pub 17, page 7, and you will see them listed here. Who should file? And even if you do not have to file, you should file a federal tax return to get money back if any of the following conditions apply. You can see federal withholding is an option, earned income credit is an option, the additional child tax credit is an option, and then there's several other options listed as well. Number 11, a dependent that had no earned income and received investment income of $850 during the year is required to file a tax return. The answer to that is false. You can go in Pub 17 to page 6 and take a look at Table 1-2. And here is Table 1-2. It says you must file if any of the following applies. Your unearned income was more than $950. Well, the only income he has is $850 for the year. Whether it's earned or unearned, it's less than $950. So 11 is false, not required to file. Number 12. A child under age 19 who qualifies as a dependent of his parents receives $1,800 of interest income during the year. Since this is his only income, the child will not be required to file a tax return. And the answer is false. Again, we go to Pub 17 and look at page 6, Table 1-2. What is of interest to us here? His income is $1,800. His standard deduction is going to be limited to $950, or his earned income plus $300. Well, he doesn't have any earned income. He could increase his standard deduction if he's age 65 or blind. We've not told you that he is. So essentially, his filing requirement is going to be $950. His income is more than that. He is required to file a return. And the question is, or the statement is, that he is not required to file a return. Since he is required to file a return, the statement is false. Number 13. For tax purposes, an individual is considered to be 65 on the day preceding his 65th birthday. That is true. And to reference that, we'll go in Pub 17 to page 5. And here we are at the bottom of the middle column on page 5, age. If you are 65 or older at the end of the year, you generally can have a higher amount of gross income than other taxpayers before you must file. You are considered to be 65 on the day before your 65th birthday. For example, if your 65th birthday is on January 1, 2012, you are considered age 65 for 2011. Number 14, a married filing separate taxpayer who earned $3,700 is required to file a tax return. That is a true statement. We again go to Table 1-1 in Pub 17. If your filing status is married filing separately, regardless of your age, you are required to file a tax return if your income is equal to or greater than $3,700. Question number 15. A taxpayer may file a federal refund claim up to 3 years after the return was filed, or 2 years from the date the tax or a portion of it was paid, whichever is later. The answer to this question is false, and we've had a lot of complaints from a lot of students over the year who think that we've made a mistake here. But the answer really is false, and it's because we're getting into some very technical wording that you have multiple situations that appear to be sounding exactly the same, when in fact one or two words can make a very subtle but important difference. So to clarify, we've got, or I have, the answer key open in front of you. So Pub 17, page 18, there's a couple of different paragraphs in there, and I'm going to point them out to you, and I'm going to read ahead of time what it is that we're looking for. The time for filing a claim for a refund and limit on the amount of a refund. A claim for refund must be made within 3 years of the due date of the return, including extensions, except for tax paid by a taxpayer within 3 years of filing, or within 2 years after the tax was paid, whichever is later. This problem confuses many students because it sounds correct where it is just partially correct. A taxpayer may file a claim for a refund on a return within 3 years of the due date of the return, including extensions. Outside of this rule, however, there is a separate rule which states the taxpayer can claim a refund for taxes paid within 3 years of filing the return or 2 years from the date the tax was paid. So let's go to Pub 17 and look for these two paragraphs. The first one is right here, and I'm on page 18. Time for filing a claim for a refund. Generally, you must file your claim for a credit or refund within 3 years after the date you filed your original return or within 2 years after the date you paid the tax, whichever is later. Returns filed before the due date, without regard to extensions, are considered filed on the due date, even if the due date was a Saturday or Sunday or a legal holiday. These time periods are suspended when you are financially disabled, discussed later. If you file a claim more than 3 years after you file your return, the credit or refund cannot be more than the tax you paid within the 2 years immediately before you file the return. So the problem with this problem is that we have a claim for a refund 3 years after the return was filed or 2 days from the date the tax or a portion of it was paid. The 2-year part is correct, but the 3 years, well, that would depend. If you filed on time, you would have 3 years. But if you filed late, you would have 3 years from the time you file or 2 years from the time you pay your tax, but never more than 3 years after the original due date of the return or 2 years after you pay the tax. Number 16, you may round off cents to the nearest whole dollar when filing your tax return. Which is the correct way to round off? A, you may drop amounts 50 cents and less to the nearest whole dollar. You round up 51 cents or up to the nearest whole dollar. That's actually incorrect. The answer is B. You may drop amounts of 49 cents or less to the nearest whole dollar, and you round amounts of 50 cents or up to the nearest whole dollar. 17. You should save your tax records for at least how long? Well, the IRS says 3 years. I personally think you should keep them forever. How hard is it really to keep records forever? Well, for a lot of people, apparently, it is a big deal to keep them even for, I don't know, a week. But the safe answer that IRS recommends is 3 years. When a client asks me what I think about this, I say to them, IRS says a minimum of 3 years, but I recommend longer. It, again, isn't that difficult to set aside a cabinet where you store these things, but if people are transient, moving around a lot, sometimes it is actually quite difficult. Number 18, the deadline for filing a tax return and paying any tax you owe is extended automatically if you serve in a combat zone. That answer is true, and to find the answer, let's refer to Pub 17, page 10. Our answer key is telling you for question number 18 to look on page 10 for individuals serving in a combat zone. So let's go there together. And we're going to go to page 18, individuals serving in a combat zone. And here we are in Pub 17 on page 10. If you served in a combat zone or qualified hazardous duty area, you may be eligible for a longer extension of time to file. See individuals serving in a combat zone later. And then we move down the page, individuals serving in a combat zone. The deadline for filing your tax return, paying any tax you may owe, and filing a claim for refund is automatically extended if you serve in a combat zone. This applies to members of the armed forces as well as to merchant marines serving aboard vessels under the operational control of the Department of Defense, Red Cross personnel, accredited correspondents, and civilians under the direction of the armed forces in support of the armed forces. And then it goes on to describe more information about what is a combat zone. Number 19, you can wait until January to cash a check you received in December in order to defer taxes until the next year. Well, that is kind of self-evidently false. You're trying to reduce your tax bill by pretending you didn't have money. The reality is you did have money, and the fact you chose to not put it in your account didn't change anything. You are still required to file. But here in Pub 17 on page 11, it says, check received or available. A valid check that was made available to you before the end of the tax year is constructively received by you in that year. A check that was made available to you includes a check you have already received but not cashed or deposited. It also includes, For example, your last paycheck of the year that your employer made available for you to pick up the office before the end of the year, it is constructively received by you in that year, whether or not you pick it up before the end of the year or wait to receive it by mail after the end of the year. Question number 20. Mrs. Smith is age 65 and blind. Her husband, Mr. Smith, is age 64. The Smiths will file a joint return. What is their federal standard deduction? Well, we begin by taking the original or basic standard deduction for a married couple, which is $11,600, twice that of single, and single is $5,800. And then we add $1,150 for each occurrence that allows an increase to the standard deduction. And you are allowed an increase to the standard deduction of $1,150 for being age 65 and older and for being blind. Mrs. Smith is age 65 and blind, so that's two occurrences of the extra standard deduction. $1,150 plus $1,150 plus $11,600 makes her standard deduction $13,900. Number 21, Jonathan is single. His parents will claim an exemption for him on their 2011 tax return. He has interest income of $690 and wages of $250. He has no itemized deductions. Jonathan's standard deduction is blank. Well, the lowest his standard deduction can be is $950. There can be a temptation to look to his total income, which is $250 of wages and interest of $690, and see if that takes us anywhere. Well, he's allowed to take his wages plus $300, which would give us $550, or he's allowed to take $950. Those are the two choices he has for standard deduction. Of course, he will take the higher of those two, $950, and his income of $940 actually doesn't factor into the filing requirement at all. Betty, a 23-year-old full-time student, is claimed on her parents' 2011 tax return. Betty is married and files a separate return. Her husband does not itemize deductions on his separate return. Betty has $1,500 in interest income and wages of $2,000. What is Betty's standard deduction? Well, we first look to her earned income, which in this case is $2,000, and we add $300. When we do that, we get $2,300. That is going to be the amount of her standard deduction. Again, this is a standard deduction question and not a filing requirement question. Number 23, and she would be required to file. Number 23. Archie, who is single, is claimed on his parents' 2011 tax return. He is 17 years old and blind. Archie has dividend income of $2,400 and wages of $600. Archie's federal standard deduction is blank. Well, for this one, we're going to take his wages of $600, and we're going to add $300, and then we're going to add $1,450. Or we're going to take $950 plus $1,450. And whichever of those gives us the higher number will be his standard deduction. So if we take $950 plus $1,450, we get $2,400. And if we take his earned income plus $300 plus $1,400, we get $2,350. The higher of those two numbers is $2,400. And incidentally, $2,400 was the only option we offered that was remotely correct. Number 24. If you want to file your federal tax return electronically, you must use an electronic PIN, and that is the correct answer, number B. You can refer to IRS publication page 17, pages 8 and 9. And you can see I've highlighted a paragraph here on page 8 that says electronic return signatures. If you file your return electronically, you must sign the return electronically using a personal identification number or PIN. If you are filing online, you must use a self-selected PIN. If you are filing electronically using a tax practitioner, you can use a self-selected PIN or a practitioner PIN. And the last two questions of this test, beginning with number 25. If you are paid to prepare a federal tax return for an individual, you must have a tax preparer identification number or PTIN from the IRS to put on returns. The answer is, actually A is the correct answer. You are no longer allowed to use your Social Security number to identify yourself as a paid preparer on a tax return, and the number, the PTIN, is mandatory. We can go to Pub 17, page 13, and look under Paid Preparers. Anyone you pay to prepare, assist in preparing, or reviewing your tax return must sign and fill in the other blanks, including their preparer tax identification number, in the paid preparers area of your return. That's kind of an interesting thought, because what it's saying is if all someone does is prepare their own return, come into you and ask you to review it, and they pay you to review it, and after you review it, you're supposed to sign it. That's actually an important detail. I may not personally want to sign a return that I didn't prepare top to bottom. But I frequently do take a look at clients' tax returns. You know, if they come in and they want me to look at it for them real quick, I might, but generally you're putting yourself on the hook liability-wise. 26, if you do not file your federal return by the due date, including extensions, the penalty is, and the answer is D, all of the above. Let's see what the options are. Usually the penalty is not more than 25% of the tax not paid by the due date, and usually 5% per month or part of a month that the tax is not timely paid, and a higher amount if the return is more than 60 days late. It can potentially be a higher amount. So let's take a look. We've got penalties beginning on page 19, filing late. If you do not file your return by the due date, including extensions, you may have to pay a failure to file penalty. The penalty is usually 5% for each month or part of a month that a return is late, but not more than 25%. The penalty is based on the tax not paid by the due date without regard to extensions. And then if the tax return is more than 60 days late, if you file a return more than 60 days after the due date or extended due date, the minimum penalty is the smaller of $135 or 100% of the unpaid tax. So that may be more than or less than the amounts shown in the preceding two choices, 5% per month or part of a month that the tax is not paid, but generally not more than 25%. The exception is that if your tax bill for the year or what you owe with your tax return is only $10 and you file it late, the minimum penalty is going to be 100% of the unpaid tax. In this case, it would be $10, or the smaller or $135. So if you owe $500 when you file, you don't pay it, and you wait more than 60 days, your minimum penalty will be $135. So that concludes the review of the Session 1 quiz answer key. Let's move on now to a review of the Session 2 homework assignment. The homework assignment for Session 2 is different than most of the homework assignments that are going to follow from this point forward. Beginning with Session 3, homework assignments are nearly always going to involve preparation of a tax return. But for Session 2, we really wanted to get cemented in your mind the filing status and dependent rules to ensure that you're applying those correctly. And so with homework assignment A, we had a series of questions where we ask you to enter all of the legal possible choices for filing status. When we did classwork for Session 2, we asked you to select the most advantageous filing status. But for homework, we're saying, what are the potential filing statuses out there that they could choose from in the first place legally? And we already covered question number 1 at the end of Session 2, so let's begin with question number 2 in the homework assignment. Samantha Jones is married to Mark Jones. They reside in San Francisco. Samantha wants to file single because they were married in September and were unmarried for more than half the year. List all possible filing statuses allowable for Samantha. Since she is married, her possible choices are married filing joint and married filing separate only. Zetta Smith divorced her husband in December. Zetta's 30-year-old single daughter, Beth, lived in Zetta's home all year. Beth didn't work much last year, earning only $2,500. Therefore, Beth is a qualifying relative, and Zetta can claim her as a dependent. Zetta paid more than half the cost of keeping up her home at 222 Hippity Hop Lane. List all possible filing statuses for Zetta. Well, since Zetta is divorced, she is single, and that's always a possibility. And because she is maintaining a household in which a qualifying person lived for more than half the year, she is able to claim the head of household status as well. Question number 4. Zetta Smith's situation is the same as in question 3, except that her daughter Beth worked all year and does not qualify as a qualifying relative. What are the possible filing statuses allowable for Zetta? And we're left with single. Zetta must file as single because her daughter does not qualify for her for head of household if she is not a dependent. The only way a child can qualify you for head of household without being your dependent is if that child is being claimed by the non-custodial parent and the child lived with one or both parents for more than half the year. And in this case, no non-custodial parent is claiming the child. Zetta, therefore, must be able to claim her child as a dependent. She is not able to claim the child as a dependent, and therefore her filing status is single. Number 5, Jack Sunder lives at 5066 Rainy Day Lane in New York. His wife Martha died in 2010, 1 year ago. And Jack's stepson Johnny Lane, age 13, lived with Jack all year. Jack paid more than half the cost of keeping up his home. List all of the possible filing statuses allowable for Jack. Well, of course, Jack's child is a stepchild to him, but that isn't relevant once that relationship was created in marriage. Death or divorce does not change it. His stepson is his son for tax purposes. He is left, therefore, with the filing status choices of single. Since he is no longer married, he could file that. He could also file as head of household. He kept up a house for more than half the year in which his qualifying relative or qualifying child lived. But he can also qualify for qualifying widow or widower because this is one of the 2 years following the year of death, and his qualifying child lived with him for the entire year. So, of course, of the 3, qualifying widow is the best choice. He could use any of those 3. Number 6, Zane Gray is single and paid over half the cost of keeping up his home in Houston, Texas, for himself and his son Joshua, who is age 5. Jane's ex-wife Laura claims Joshua as a dependent. List all possible filing statuses allowable for Zane. Well, Zane can file as head of household. He could also file as a single because he is divorced. Head of household is the better option, so that's what he should go for. As long as Zane is single and paid over half the cost of keeping up a home for his unmarried son, he can be head of household even though he cannot claim a dependency exemption for his son, as long as he would have qualified to claim the exemption if not for the divorce or separation agreement. So Zane may also file as single. So between the two of them, the son's dependency exemption is going to the non-custodial parent because that's what the divorce decree says. So with qualifying child and head of household, you need to be able to show that you've kept a household up for a child who lived with you for more than half the year. And typically you need to be able to claim that child's exemption as well. However, if the reason you are not claiming the exemption is because that exemption has been released to the non-custodial parent, you are allowed to claim that child. That child can qualify you for head of household. Number 7, Sally Summers is married to John Summers. Sally lived with John all year in Aloha, Oregon, but doesn't want to file a joint return. Sally earned most of the household income and considers herself to be the head of the household. She wants to file as head of household and claim her 2 children as dependents. List all possible filing statuses allowable for Sally. So she's married to John, and she lived with him. She's therefore left with 2 choices, married filing joint or married filing separate. Number 7, Sally Summers is married to John Summers and lived with John all year, but doesn't want to file a joint return with him. Sally earned most of the household income and considers herself to be the head of the household. She wants to file head of household and claim her 2 children as dependents. What are the possible filing statuses available for Sally? Well, head of household is not one of them. I can assure you of that. Since she was married and lived with her husband in the last 6 months of the year, her choices are only married filing joint or married filing separate. Number 8, Sam Sanderson is married to Jill Smith and lives in Memphis, Tennessee. Jill has been in a nursing home all year because she is ill. Their son, John, age 16, has been at home all year. List all possible filing statuses allowable for Sam. Again, because they're married and they live together, their choices are married filing joint, married filing separate. Head of household doesn't even begin to factor in. Number 9, Sandy Peters is single and lives at 1234 9th Avenue in San Francisco. She pays more than half the cost of maintaining a separate household for her mother, Jean, who qualifies as Sandy's dependent. List all possible filing statuses allowable for Sandy. Since she is single, she qualifies for that status, and because she meets all tests necessary for claiming her mother's dependency exemption, plus she pays over half the cost of maintaining a household for her mother, she can be head of household. And this is regardless of whether or not her mother lives with her. That's the only exception. Normally, head of household, the person has to live with you, except when that person is your parent. Number 10, Jackie Jones is married to John Jones and lives in Virginia Beach, Virginia. John is a Marine sergeant who left home in May and has been in a combat zone for the past 7 months. Jackie has a dependent child and worked part-time during the year. What are the possible filing statuses allowable for Jackie? Again, married filing joint and married filing separate are her only choices. I'll give you a little bit more information here in the answer key to take a look at. Since John is serving in a combat zone, he has an automatic extension of time to file and pay his taxes. It is often the case that a member of the armed forces will sign a general power of attorney authorizing his or her spouse to carry out the financial matters of running a household while they are overseas. If this were true for John and Jackie, she could file married filing joint even though he is not even available to sign the return. Jackie cannot file as head of household even though John did not live with her during the last 6 months of the year. This is because the time he spends serving in the armed forces overseas is considered to be time spent at home because the absence is temporary. Also see Publication 17, page 22, Spouse in Combat Zone. Because Jackie's spouse is serving in a combat zone, she is permitted to sign for her husband if she attaches a statement to the return which states that he is serving in a combat zone and is unable to sign himself. Number 11, Mike Mitchell maintains a small apartment for himself and his son, George. George lived at home with Mike for 7 months last year. Mike lived apart from his spouse, Jane Mitchell, for the entire year. List all possible filing statuses allowable for Mike. Well, Mike is married. He could file married filing joint or married filing separate, but because he did not live with his spouse at any time during the last 6 months of the year, and because he maintains a home for himself and his son, he is able to select a possible choice in head of household. Number 12, Jane Mitchell is married to Mike Mitchell, who we just talked about up here. She kept up a home for herself all year. Her son George lived with her for 5 months. List all possible filing statuses allowable for Jane. She has a choice between married filing joint and married filing separate. If her husband Mike selects head of household, Jane will be left with married filing separate. Number 13, Tiffany Smith was widowed in 2010, and then in 2011, Tiffany's 19-year-old son, Jake, left home to go to college. Jake is attending Oregon State University and has a part-time summer job. Jake comes home for summer and Christmas. Tiffany keeps up her home all year. Assuming Jake does not provide more than half of his own support, what possible filing statuses can Tiffany use? Well, the answer is certainly single. Once she's widowed, the year after that, she is a single person. She could go for that. She could also qualify for head of household. After all, she is keeping up a household for her son. And then another possible choice is qualifying widow, since this is within 2 years of the date of death and her son is considered to have lived with her. And that's the kicker on this one. Jake's away at college. Does that mean he's away at college, or does it mean he's living at home, or is it kind of a part-time deal? How does it work? Well, IRS says that if you are away from home for a temporary absence, that the temporary absence is the same as living at home. Therefore, when Jake is away at college, he is considered to live with his mom full-time. Number 14, assuming the same facts as in 13, what possible filing statuses can Jake use? Well, that's a lot of information to come to the bottom line conclusion, which is that Jake is single. He's not married, and that's his only choice. He is a single dependent. Number 15, Sally Hamper is not married. She keeps up a household for herself and her boyfriend who lived with her all year but didn't work and was a full-time student. List all possible statuses allowable for Sally. So she's not married. She kept up a household for her boyfriend who lived with her all year but didn't work and was a full-time student. Well, the fact that he was a student isn't relevant. He's her boyfriend. If you lived with her all year as a member of her household, she could qualify to claim him as her dependent. But a person who is not related to you can never qualify you for head of household. And to clarify that, let's go to the IRS table and take a look at that. So I'm looking at table 2.1 or 2-1 in Pub 17, where it says, who is a qualifying person qualifying you to file as head of household? And we go down until we get to this qualifying relative other than your father or mother, such as a grandparent, brother, or sister who meets certain tests. If you have a person who lived with you the entire year and he or she is related to he or she lived with you for more than half of the year, and he or she is related to you in one of the ways listed under relatives who do not have to live with you in Chapter 3, and you can claim an exemption for him or her, then that person is a qualifying person. But then we go down where it says he or she is not related to you in one of the ways listed under relatives who do not have to live with you in Chapter 3, and is your qualifying relative only because he or she lived with you as a member of your household for the entire year. Well, that person is not a qualifying person for head of household. So Sally is not married, she is single. She cannot file as head of household because she did not keep up a home for the year for a person who is related to her. And the boyfriend, although he lived with her all year as a member of her household, obviously he's not related to her, but he could be her dependent if he meets all of the other dependency tests. And number 16, Laura Jones is 18 years old. Her 7-month-old daughter lived with her from the time she was born. Laura worked 5 months during the year. Laura did not pay more than half the cost of keeping up her home for the year. List all possible filing statuses allowable for Laura. Well, the answer is single. She's not able to claim her child's dependency exemption. She didn't work. Even if she did work, she didn't pay enough to keep up the household. So head of household is not going to be an option for her. Since she's 18 years old, it's probable that she's living in the home of her parents and that she is even a dependent of her parents. Session 3, password number 1 is powder, P-O-W-D-E-R. So that concludes homework assignment number A for session 2. Let's move on to the review next of the answer key for homework assignment B. And the homework assignment answer keys are also located under the materials tab for session 3. If you have not already done so, you can go print them. I will be referring to them as I review. Right now I am just about to close the homework answer key A for session 2, and I will be opening homework answer key B. So homework assignment B is a fairly difficult homework assignment, I feel. We're asking you on each of these questions to consider multiple options that have to be determined. The first of which is filing status. Select the correct filing status for the filer. Then item number B, for each problem, determine the number of qualifying children who can be claimed as dependents on the tax return. Item number C, the number of qualifying relatives who can be claimed as dependents on the tax return. And item number D, the number of dependents that are eligible for the child tax credit. We can begin with question number 1, which we covered at the end of our last class, but it won't hurt to review it again. John and Martha, a married couple, paid over half the cost of supporting their daughter, Georgia, age 28, who was unemployed during 2011 and had no gross income. Well, their filing status could be separate or joint. Joint is likely better. They do not have a qualifying child because their daughter is too old. Georgia is not under age 24 and a full-time student, nor is she under age 19. She's 28 years old, but she could be a qualifying relative. So we would say that there is one qualifying relative. She is too old for the child tax credit, so the child tax credit ranks out at 0. So for question number 2, Jack and Jane are married. Their daughter Alice was born in December of 2011. Alice lived with all of her support. For the parents, the better filing status is probably married filing a joint return. Their child is considered to have lived with them for the entire year because she was born during the year and lived with them the time that she was alive. That means that she is a qualifying child. They're allowed to claim one qualifying child. They have no other qualifying individuals in the house, so the qualifying relative is entered as 0. And their child, because she is under age 17, will qualify them for the child tax credit. Number 3, Stephen provides all of the support for his girlfriend, Frances, and her son, Jake, who is age 8, and lived with him all year. Stephen is single. He is not related to Frances or Drake. Well, this is kind of a bum deal for Stephen. He is not going to qualify for head of household because he did not keep up a home for a qualifying person who was related to him. He does, however, have 2 dependents, and therefore both Frances and her son Jake will be qualifying relatives for Stephen. But also, since Stephen is not related to Jake, he will not be able to claim a child tax credit for Jake. So essentially, the filing status is single. He is allowed to claim 2 dependency exemptions for qualifying relative. Number 4, Terry, age 40 and single, provided over half the cost of supporting his mother, Joan, age 71, who lived with Terry for the entire year. Joan received $7,200 in non-taxable Social Security and earned $1,895 of interest on money in her savings account. The filing status for Terry will be head of household. He could file as single, but head of household is the better choice. Qualifying child, none. His mother is too old. Qualifying relative, she is his qualifying relative. She is too old for the child tax credit. Question number 5. Sandy and her husband Kurt are sending their child Jeff, age 23, to Portland State University. Jeff was a full-time student for 6 months. He earned $5,500 working at the local gas station. Sandy and Kurt provided over half of his support. Well, they're probably going to file a joint return, and since their son was a full-time student for at least some part of each of 5 calendar months during the year, and he was under age 24, he is a qualifying child. So we have 1 qualifying child, 0 qualifying relative, but because Jeff is over age 16, he does not qualify for the child tax credit. Number 6, Stacy and Herbert, a married couple, provided all of the support for their daughter, Susan, who is age 19 and lived with them all year. She was not a student and earned $5,600. Well, we've got kind of a bum deal here. Stacy and Herbert can file separately or jointly. Joint is probably better. They do not have a qualifying child because their daughter was over age 18. She was age 19. She is not a qualifying relative either because she fails the gross income test. Once she fails to meet the test for qualifying child, we move over to the test for qualifying relative, and under the test for qualifying relative, we are concerned about the gross income test. The gross income cannot be $3,700 or more. It is definitely more than $3,700, and therefore we do not have a qualifying relative, and of course we have no child tax credit either. Number 7, Sam is single and a kindly grandfather who provided over half the support for his daughter Sally, age 22, and her son Ed, age 3. Neither Ed nor Sally lived with Sam. Sally was a full-time student for 6 months during the year. Sally earned $7,000 of wage income for the year. Well, poor Sam, kindly grandfather or not, he gets nothing except single. And let's take a look at why in the answer key. Sam will file single. Ed did not live with Sam for more than 6 months of the year. So Ed cannot be Sam's qualifying child. The best that Sam can hope for is qualifying relative. So no, Sam may not claim Ed's dependency under the qualifying child rules. We could go over to the qualifying relative rules, and we might also consider the residency tests or the exceptions to the residency test for a qualifying child. However, the exceptions to the residency test for a qualifying child apply only for a person who is a parent of the child. Sam is a grandparent of the child and not a parent of the child, so he is not a non-custodial parent providing support. He is a grandparent providing support. Ed meets all of the qualifying child tests for Sally, and since Ed is Sally's qualifying child, he cannot be the qualifying relative of Sam. Sally cannot agree to let Sam claim Ed because Sam is not Ed's parent. Ed qualifies Sally for the child tax credit. He is not Sam's qualifying child, so he does not qualify Sam for the child tax credit. So essentially in this situation, we have Sally, who will have a dependent who is a qualifying child, who also qualifies her for child tax credit. She will not be head of household. Then we move over to Sam. Sam gets nothing. He gets single. So it's kind of not the best way. The tax code is not working to benefit Sam in any way. Number 8, Jack, a single taxpayer, provided over half of the support for his 13-year-old daughter, Stacy. Even though Jack is the custodial parent, he temporarily allowed Stacy to live all year with her mother, Karen, while he served in the military overseas. Jack continues to maintain a home for Stacy, and she will return to live with him when he returns from service overseas. Karen works full-time and was divorced from Jack in 2003. The 2003 divorce decree states that Jack is the custodial parent and is entitled to claim Stacy's dependency exemption for all years. Provide filing status and dependency answers for this question as they relate to Jack. Well, because Jack is maintaining a household for his child, his qualifying child, he is considered to be eligible for that head of household filing status, even though they did not live together. The reason is that he's away on a temporary absence due to military service. Therefore, the time that he is away is actually considered to be time spent at home. So for that temporary absence period, she is considered to live with him. Therefore, he qualifies for head of household. He also qualifies for claiming a qualifying child. She is not a qualifying relative because she is his qualifying child, and she is under age 17, so she qualifies for the child tax credit. Number 9, assume all of the same facts as in question number 8, except that the divorce decree does not provide or state who the custodial parent is. Also assume that Karen has not signed Form 8332. What would happen to Jack's filing status and dependency in this situation? If the divorce decree does not award custody to Jack, then as IRS is concerned, or as far as IRS is concerned, they're going to actually look to where that child lived. And if the child lived with the mother, then the child will qualify the mother for head of household and be a qualifying child of the mother also for child tax credit. So a divorce decree is all important, or Form 8332 is all important. And in this number 9, there is no divorce decree. There is no 8332. In question number 8, we have a divorce decree. And so it makes all the difference in the world for Jack. In the first situation, he gets all of the benefits, and in the second situation, he gets none of the benefits. So that concludes the review of the Session 2 homework assignment. It is now time to pause video playback. Go to the assignments page for Session 3 of the Basic Tax course and take the Session 2 quiz. When you are finished completing the Session 2 quiz, please resume video playback for the Session 3 lecture. And today's lecture is going to cover wage, tip, and interest income. Topic of today's class is investment, wage, tip, and other income. And I'm not going to read you the objectives of today's course. You can read through that on your own. We're going to move right to the first item of the day, which is wages, salaries, and tip income. And we begin with a very elementary concept of who is an employee. And I take the time to talk about who is an employee because a lot of people don't seem to understand that there are employment laws that determine when you have an employee and when you are an employee, and when you are not an employee and are considered to be an independent contractor. And of course, whether you are an employee or not is a key element of preparing your tax return. Now, if you are a small business owner and you employ people to work for you, you have a very much bigger issue to deal with in terms of payroll laws and whether or not they affect you as an employer. And this course is not about employment laws, although we will touch on them somewhat. We do get a bit more into payroll law in our course on self-employment income. But for today, we're really just interested in identifying when we have an employee. An employee is a person who performs services under the direction and control of an employer. Remember the simple rule of thumb. If you are told where to work, when to work, and how to work, then you are probably an employee. And it does not matter if you work from your home or use your own tools. What matters is whether your employer controls the method and manner in which you perform your services. So direction and control is the key thing that IRS payroll auditors and state payroll auditors look at. If direction and control is a factor of how you provide your work, then typically you will be deemed to be an employee. You are an independent contractor, essentially, when you run your own business. And here's some illustrations. You work for XYZ company as a secretary. You are told what hours to work and when and where to perform your duties. You are an employee, and your employer should withhold taxes and issue you a W-2. It doesn't matter whether you're a secretary that worked for a day or a week, or whether you're a secretary that works for 3 or 4 different employers part-time. In every case, direction and control is going to determine whether or not you are an employee and who should be issued a W-2. But let's look at a slightly different situation. It would be an incredibly rare one, but it's just to illustrate to you the difference in how we might identify someone as not an employee. Assume the same as for illustration 1, except you are self-employed as a secretarial service provider. You market your business to many different clients. You employ a staff of secretaries whom you send to work at various countries. You have control over where and when you work. Sometimes you perform secretarial services for your clients when one of your employees calls in sick. Because you are in control of your own business, you are not an employee and you are self-employed. Let's look at nannies. Now, in the news, on television, there always seems to be some politician in trouble somewhere for violating nanny laws. And they're not alone. Lots of people who have nannies and violate nanny laws. It somehow just doesn't seem right that if you have a nanny in your house, they should be an employee. They're just a babysitter, right? You pay them cash. Why should it matter? But IRS cares about anyone making money, and they care about any time someone's making money as an employee because they want the employer to pay Social Security tax, Medicare tax, unemployment tax, probably carry workers' compensation insurance, and so on. So let's look at number 3. You are a nanny. You are responsible for the care of 2 children at Mrs. Jones' home. You report to work 3 days a week. Mrs. Jones tells you how to care for her children and when to care for them. You are an employee of Mrs. Jones. If she pays you $1,700 or more for the year, she is required to issue you a W-2. Now, I have a little asterisk next to this W-2 comment because the $1,700 rule applies only to household employees. All other employees must receive a W-2 if they're even paid $1. Now, assume the same facts as in illustration number 3, except that you run a daycare business from your home. Mrs. Jones brings her 2 children to your home 3 days per week. You decide where and how to care for these children. That makes you self-employed. Now, if you are an employee, when you start your new job, you need to fill out a W-4 and give it to your employer. W-4s are rather confusing. I think they're up to 4 pages long with multiple worksheets, and if you ever sit there and try and read them, and believe me, I have, you get more and more confused with every line that you read. It just makes much more sense to completely ignore the instructions and just know what you're doing. And how do you know what you're doing? Well, after doing this for 20 years, I've kind of figured it out. But here's the bottom line. The form goes through worksheets, and the first worksheet right here is for your personal allowance. And then it asks you to go through and answer all of these questions. Are you going to get to be head of household? Do you qualify for the child tax credit? Are you married? And so on. And you keep entering ones in here where it's called for until you get to a number, and you total the number up, and you enter it on line 5. The thing is that people don't read the instructions fully, or even if they do read them fully, they're so confusing, they just get themselves into a tangled mess and enter the wrong number. So the bottom line I look at for any individual is, firstly, I start with, are they married? If you're married, the IRS, or not the IRS, but the withholdings tables that employers use to withhold taxes give no regard whatsoever to the fact that your spouse might have a job and work. And so when you answer the question, yes, I'm married, you have to be thinking about what are the consequences of saying, yes, I'm married. If I say, yes, I'm married, automatically the tables are going to withhold less tax than if I say I'm single. But if my spouse works and I work, we're actually probably going to pay more tax than 2 single people should pay. So the rate of withholding for married is less than the rate of withholding for single. And here we see that we've got single, married, and married but withhold at the higher single rate. So if you check this third box or this first box, it has the same effect. The W-2 withholding should be at a single rate. And when you're dealing with married tax filers, I tell them if you both work, you'd better check single. And they say, but wait, I'm not single. I can't check single. Well, that's why they have this other box called married but withhold at the higher single rate, but it's the same thing. And if you check this box here that says married, they're going to hold out less tax. Now, that won't be a problem if you've got enough deductions, but it will be a problem if the only thing you're claiming is your standard deduction and you don't have any dependents, because it's just going to be that not enough is withheld. And if both you and your spouse both claim married, both the jobs assume you have a non-working spouse. So now you have 2 incomes with deductions being claimed too much. And the bottom line is you come in and you file and you owe. Now, the other time that people get themselves in trouble is when they work more than 1 job, because each job exists in a universe by itself without regard to any other jobs you have in terms of withholdings. So when you go and apply for a job and that job pays you $5,000 a year part-time and you claim single 1, odds are by the end of the year, virtually nothing will be withheld. But if you take that $5,000 second job and add it to your $40,000 main job, should you have had tax withheld on the $5,000? Yes, you should. So my recommendation is that for whatever main job you have, you claim single and one at the most, unless you're entitled to other deductions. And if you work any other jobs, it's single zero on the other jobs. And if you have enough income coming in from other sources, it's best to go single zero everywhere and maybe even hold out some extra tax. Now we're at a point now, at least in our business, where a number of our clients are paying alternative minimum tax. And if you have upper end clients or higher income clients who are paying alternative minimum tax, these tables are shot. And they need to be factoring single zero plus withholding out extra usually to compensate for that. Now moving on in the W-4, you can see there are additional worksheets. One of those is for factoring if you have additional deduction items. And the other one is what to do when you have two earners with multiple jobs. And ultimately, it's a very long worksheet in terms of what I think complexity to go through and figure out how many exemptions to claim. But the bottom line of what I say is that every exemption you ever claim on a tax return is worth $3,700 of deduction. So if your itemized deductions because you own a home are going to total $20,000 and your standard deduction would be $5,800, I'm going to go $20,000 minus $5,800, divide the difference by $3,700, and that tells me how many deductions, quote, my house is worth. It's just kind of a trick I've learned over the years. Skip the worksheet. Moving on. So Form W-4 includes 3 separate worksheets that help you to identify the filing status rate and the number of exemptions you should claim. You complete Form W-4 and submit it to your employer. Your employer will withhold tax at the rate you indicate on the form, and decisions need to be made on the form when you're completing it, and these decisions include whether to withhold at a single rate or at the lower married rate, how many withholding allowances to claim, because each allowance reduces the amount of tax being withheld, whether you want an additional amount of tax withheld, and whether you are claiming an exemption from withholding so that no tax will be withheld. And restrictions apply if you want to do that. Now this is a class for tax preparers. Why am I explaining to you how to fill out a W-4 form? Well, because how many of us have ever had a client that we told them they owed and they were upset by that and wanted to know why they owed? Okay. All right. So part of what I feel as a tax professional as a service to my clients is when I get to the bottom line and I tell them they owe, I want to know exactly why they owe, and they want to know why they owe, and they want me to explain to them what they owe and what they can do to not owe in the future. And the starting point I look at is to figure out how many exemptions they've been claiming and what status they've been claiming, and adding up all of the other sources of income they have to arrive at what I think should be on their W-4, and then I'll even fill out a new W-4 and tell them to sign it and give it to their employer. And I do that regularly every tax season. I've done it for years. And you know what? When I do that, they actually sometimes listen to me, and they take it to their employer, and then the next year they come back and they don't owe, or they owe less, and they're happy about that. So it's just a customer service issue. Yes? Married filers. Many filers are surprised to learn that withholdings at the married rate are lower than for single. The married rate, as I already said, essentially assumes that only one spouse works. If two spouses both claim married on their W-4, they often find out that they owe when they filed. Working a second job also triggers owing a great deal of the time. Now we're going to move on to wages, definition of wages, and how to read a W-2. You report all employee compensation as income earned from wages, and employee wages include salaries, tips, bonuses, awards, commissions, allowances, severance pay, sick pay, and the value of fringe benefits. Income from wages received and income from payroll advances for services yet to be performed should be reported in the year you receive payment. And we're going to take a look at a W-2. There's a few things that you should know about a W-2, and although you've possibly been preparing tax returns for many years, you might be going, good God, she's going to go over a W-2 with me. Well, it doesn't hurt to understand the W-2 in its entirety, so yes, I am going to do that. So there are some important things you need to know. Firstly, All compensation which you receive for services you provide to your employer should be properly reported by your employer on Form W-2. They should not issue you a W-2 when they are required to. By law, all employers are required to issue W-2s to their employees by January 31st. When issuing a W-2, an employer will normally mail 3 to 4 copies of this form to the employee, and the employer will also mail a separate copy or electronically submit a separate copy to the Social Security Administration. The Social Security Administration records information on the W-2 into its files. And Social Security is interested in what's on the W-2 because it uses the information to track incoming Social Security and Medicare taxes paid. And of course, the Social Security Administration uses that income to determine how much Social Security you're going to be entitled to when you retire, or if you die, how much Social Security your beneficiaries will receive. When Social Security has finished processing the W-2, it will forward the data on the W-2 to the IRS. But it can take up to 18 months from the time Social Security receives the W-2 before the IRS computers can match the information on that filed W-2 with the income reported on the tax return. This is why it's possible to file a tax return electronically and get a client a refund, but not have the IRS send a letter to that client that there's a mismatch between wage reporting on the tax return and income on the W-2s until a year and a half later. Why don't they do it sooner might be the question. And the answer is IRS doesn't have the information early on. Early on, it is only with Social Security. Now, I do believe they're working on speeding up that process, but as we sit, I haven't seen any indication that it has sped up. Now, here we have a W-2. And of course, most people do not get W-2s that look exactly like this one. But even if it looks different from this W-2, the box numbers should all line up. And the only exception to this is the post office. I'm not sure why the U.S. Postal Service has a different looking W-2 with a bunch of extra boxes, but it does. So when you see a U.S. Postal Service W-2, they are an odd looking animal, but you'll just have to look for the boxes that are relevant, like Box 1 wages, Box 2 federal income tax withheld, Box 3 Social Security wages, Box 4 Social Security tax withheld. Typically, if you take Box 3 and subtract out Box 12, you'll get Box 1. But not always. It's one of the things you can look for. Social Security tips are separated from Social Security wages, so when a person is receiving tips, Box 3 plus Box 7 minus Box 12 could equal what's in Box 1, or maybe not, but it usually does. We also have other additional boxes here, including allocated tips, dependent care benefits, and information for statutory employee checkbox, retirement plan checkbox, and third-party sick pay checkbox. We also have Box 12 where codes are entered, and the most common codes we'll see here are C, which has to do with life insurance benefits, also a D for 401k plans, or an E for 403b plans. I've also seen a code P in here for deductible moving expense reimbursements. Those are items that appear in those boxes. Across the bottom, we have state information. Some states have nothing here because there is no state income tax. So for example, if you come from Texas or you come from Washington State, those are examples of states that don't have a state income tax. So very often the entire state line is empty. But most states do assess income tax of some kind and will have state information entered here. I'm not going to read you page after page of what is supposed to be in these boxes and how to read them. But I am going to take a look at a couple of important items, one of which is Box 4, the Social Security tax withheld box. You are required to pay Social Security tax on the first $106,800 of your earnings. And generally, your employer should withhold 6.2% of your Social Security wages for paying your share of Social Security tax. That's not the full and complete tax, however. That's only half of the Social Security tax. Your employer is responsible for paying an additional 6.2% on your behalf. That is why employers have an incentive to give 1099 miscellaneouses instead of W-2s, because they're hoping that no one will complain and they'll get away without paying their share of the Social Security tax. But their desire to not pay the tax does not mean that a particular worker should have to pay it. And the law does provide protection there for a worker who wants to fight it. Now, there is an asterisk next to this 6.2%, and the reason for that is we are on a payroll tax holiday right now. For 2011, and it has been extended all the way through 2012, the Social Security rate is reduced by 2 percentage points for employees. And this means the employer should withhold only 4.2% of tax from your Social Security wages. But the employer is still subject to the full 6.2% on their half. Now, this payroll tax holiday under the Social Security withholdings is a replacement for the the Making Work Pay Credit. So if you remember, we had a $400 credit per worker for tax years 2009 and 2010. And that temporary credit expired at the end of 2010. It was replaced with this reduction in payroll taxes, and depending on your income level, it's a good thing or a bad thing. If you earn more than $75,000, it's a good thing, because if you earn more than $75,000 under the Making Work Pay Credit, you actually were subjected to a phase-out and you stopped getting the credit. You lost out and didn't get it at all. Under the Social Security reduction, there's no limit on the amount of Social Security tax you can save until you hit the full $108,000. And if you take $108,000 by 0.2% or 2%, yeah, you go 108 roughly, like 900, right? You can save up to $2,100. Is that right? Yeah, more. It's a way better break. Yeah. So if you're right up there maxing out on Social Security, this payroll tax holiday saves you way more money than the Making Work Pay Credit did. And if you're lower income, you might still be saving more, but it's possible you're saving less because the Making Work Pay Credit maxed out at $400. All right. Medicare tax withholding rate is 1.45%. There is no limit on the amount of wages you earn that is subject to Medicare tax. So if you earn $500,000 on a W-2 or $1 million on a W-2, you will pay that 1.45% on the full amount. But Social Security, you max out at that top limit amount of $106,800. Box 8, allocated tips. Under the law, certain types of restaurants and bars must report tips in proportion to their gross receipts from food and beverage sales. If the percentage of tips received is too low, an employer must allocate tips to employees who have received less than a certain amount, and that percentage is typically around 8%. If an employee has a W-2 with allocated tips in it, they're required to pay tip tax on the allocation unless they kept a tip log which proves they did not get the amount or that they got a lesser amount. And we're going to spend more time talking about that a little bit later on in today's class. Dependent care benefits. If your employer offers dependent care benefits, you can decrease your taxable income in Box 1 of your W-2 by submitting receipts to your employer. Any benefits you receive up to $5,000 if filing joint or $2,500 if filing separate are not subject to income tax, providing you do actually have qualifying dependent care expenses. Box 12, the amounts reported here are identified by code levers. You should refer to the back side of the employee copy of the W-2 for instructions on what these letters mean. So the W-2 actually has these codes on the back of it and the definitions. So you shouldn't ever be holding a W-2 and looking at a code on it and going, gee, I wonder what that means. Oh, well, because you just flip it over and they're there. And and the employer is required to have that information there. So if they issued a W-2 that is missing it, they're out of compliance with the law. But as a tax preparer, all you need to do is go to the IRS website, open up the W-2 instructions, and all the codes will be in there anyway. So the codes, I've got them all listed here for you. And some of the more important ones that you should be aware of are non-taxable combat pay. If you're dealing with military, that can be important. Also, I mentioned earlier code P had to do with excludable moving expenses, and I mentioned C had to do with life insurance. You can see cost of group term life insurance. Code D, elective deferrals to a 401k plan. Code E, elective deferrals to a 403b salary reduction plan. So if you want to know what a code means in those boxes, that's what it's for. Box 13 is employee information. The 3 different check boxes that I showed you just at the start when we were first looking at that W-2 included statutory employee, retirement plan, and third-party sick pay. And typically, you know, people do get third-party sick pay all the time, and the unique thing that you'll see about a W-2 that has third-party sick pay is it usually doesn't have any Social Security or Medicare tax withheld on it. It's usually just got wages. I don't exactly know why. I've never researched that, but that's what I've observed. But more commonly, what I'm concerned about is whether or not the retirement plan box is checked, because if the retirement plan box is checked, then the employee's ability to claim a deduction for contributions to a traditional IRA plan is going to start phasing out. And our very next class on Thursday, we get into pension and Social Security income. And then next week, we get into adjustments to income. And next week, when we talk about adjustments to income, one of the items we talk about is calculating the deductibility of a contribution to an IRA. And if the pension plan box is checked on your W-2, you need to know how to figure the deductible portion of an IRA because there are limits on it that are affected when that box is checked. The statutory employee box being checked is a very relevant thing. It's not common because statutory employees themselves are relatively unusual. But if you get a W-2 that has that box checked, it means you're working on a tax return for a statutory employee. And the following types of workers are called statutory employees: a driver who distributes beverages other than milk or meat, vegetable, fruit, or bakery products, or who picks up and delivers laundry or dry cleaning, if the driver is an employer's agent or is paid on commission. A full-time life insurance sales agent whose principal business activity is selling life insurance or annuity contracts, or both, primarily for one life insurance company. An individual who works at home on materials or goods that are supplied by the employer to be returned to the employer or the employer's agent. The individual must be furnished with the specifications for the work to be done. And finally, this is the one that I come across the most often when I do run across a statutory employee. It's usually under this fourth category, who is a full-time traveling or city salesperson who works on behalf of an employer and turns in orders to the employer from wholesalers, retailers, contractors, or operators of hotels, restaurants, or similar establishments. The goods must be merchandise for resale or supplies for the use in the buyer's business operation. The work performed must be the salesperson's principal business activity. So let me give you an example. We have a shoe salesman. He works for a shoe manufacturer. He travels around the country meeting with owners of shoe stores and selling them their shoes. That is a person who is meeting all of the categories here: full-time, traveling, has a single employer, but obviously incurring large amounts of travel expenses of a type that, and basically being in command of their own work and how they set up their appointments, that would be similar to a self-employed person. But statutorily, they are still considered to be an employee. And the benefits of being a statutory employee are that you can claim your expenses on Schedule C rather than 2106. So you enter your W-2 income on the Schedule C, you enter all of your expenses on Schedule C, you arrive at your net profit, which carries to line 7 and is entered as a wage amount on line 7. So it's a good deal, and if that box is checked, that's what you need to do. So I'm going to move down now to the bottom of page 11, where we are going to talk about taxable wages and taxable fringe benefits. Federal law provides specific treatment to employee wages. Employee wages are generally subject to a variety of taxes, including Social Security and Medicare taxes and unemployment tax. And because employee wages are subjected to these taxes at both the employee and the employer level, there is a huge incentive for employers to try to avoid these taxes by giving special benefits to their workers rather than a paycheck. These benefits are referred to as fringe benefits. And while some fringe benefits are tax-free, most are considered to be the equivalent of wages and are taxed as if they are wages because, well, under the law, that's what they are. Now, here's what I have found after doing tax returns for as many years as I have. I find this is a bigger problem or a more noticeable problem when I am working with the business owner, what I see going on. That's where it becomes apparent to me what's going on. And I would say one of the worst examples I could possibly recount to you is one that came in my door about a decade ago. And this man had started up some kind of an internet sales business. He was selling some kind of health way of being healthy. It was kind of weird. He was selling audio tapes and stuff, and he really thought he was wonderful, and he had all of this money coming in. And he had this team of friends who were helping him out in his business. They all loved him, and they all worked for free. And he liked to give them gifts. He would buy them clothes, and he would buy them food, and he would buy them vacations. And he didn't have any of them on payroll. He just liked to give them gifts. And I kept explaining to him, but you can't claim a deduction for the gifts. And if the gifts really are a form of compensation, then you should be W-2ing these people, and you should be paying Social Security and Medicare tax on these people, and you should be carrying workers' compensation on these people. And the man simply would not listen to me. So after 1 or 2 years, we parted ways. But it was probably the worst example I can think of, or the best example I can think of someone who seemed to think that payroll laws had no bearing on his tax situation. But that's an extreme example. I certainly run across it in another area, and that is with S corporations. When you get into the world of the S corporation, S corporations are far more likely to be audited over payroll than they are over income tax issues. And when the payroll audit happens on an S corporation, the IRS people come in and they're looking for payroll issues. Low salary on the top part of the owners. They're also looking for expenses being paid for the owners that are considered to be a fringe benefit. One of these might be the owner has a company car that they're driving. That's one of the ones that I've seen these auditors zero in on. There's a company car, it's showing up on the balance sheet, it's titled to the company, and the owner's driving it. Oh, the owner didn't keep a mileage log? That means all of the use of this company car is payroll, thank you very much. Oh, you didn't put it on the W-2? Well, we're going to have to correct those W-2s and assess all of the payroll taxes that you didn't pay that you should have paid. Would you believe it? They also assess the income tax that should have been withheld and wasn't withheld and give this big fat bill. Now, you might be going, how can they possibly do that? And until you've actually sat there and watched an auditor do it, it is kind of hard to imagine, but they do it. And I've watched enough payroll audits on S corporations at both the state and federal level to tell you that that is what they're looking at. So auditors are on the lookout at the corporate level for payroll violations at the employer level. And if they find them, and they find that an employer has made payments to an employee or given gifts to an employee or given fringe benefits to the employee that belonged on that employee's W-2, it's technically possible that even years after that employee filed, they could get a corrected W-2 for the additional income that was not originally reported. So let's take a look at what we mean when we talk about taxable wages. The pay you receive may be paid in cash or in another form, and wages include salaries, vacation allowances, bonuses, commissions, and fringe benefits. It does not matter how the payments were measured or made to you. All of the following payments are considered to be wages paid. Your employer should include these payments on your W-2 and withhold income, unemployment, Social Security, and Medicare taxes. Amounts that an employer pays to you as a bonus for signing or ratifying a contract in connection with the establishment of an employee-employer relationship is wage. An amount paid to you for cancellation of an employment contract is also wage. Payments for you to relinquish your contract rights are also a wage, and compensation paid to you after you ended your employment if you performed these duties while you were still employed. And let's look at some taxable fringe benefits concepts here so that maybe when you see one, you know what it is. A fringe benefit is a form of pay for the performance of services, and fringe benefits are taxable and must be included in the employee's pay unless the law specifically excludes them. You generally must include fringe benefits you received in your income unless the benefits are non-taxable. Following are examples of benefits that are taxable. They include the free use of a company car, flights on aircraft provided by your employer, free or discounted commercial flights, free vacations, discounts on property or services, memberships in country clubs or other social clubs, tickets to entertainment or sporting events. In general, if your employer gave you any of those kinds of benefits, they are required to gross up your W-2 and put a higher number in box 1, 3, and 5, and obviously accordingly hold out additional taxes. Employer paid or reimbursed moving and living expenses. Non-deductible moving expenses paid by an employer on behalf of an employee are a taxable fringe benefit. If your employer paid non-deductible expenses for you, your employer must include the cost of those non-deductible expenses in your income. And the most common types of non-deductible expenses that an employer will reimburse an employee for include house hunting expenses, real estate sales expenses, temporary living expenses, and meal expenses while traveling and living in temporary quarters. So let's just suppose you're a desirable employee, a new employer wants to hire you, and they agree to pay all of the moving expenses associated with bringing you from your old home in New York City to your new home in Florida. And it ends up costing $20,000 to move you and all of your stuff and your family down. Well, the employer has to divide the cost of the move between what is deductible and what's not deductible under the rules. And if the employer paid non-deductible expenses for you, and let's just suppose out of the $20,000 of expenses paid, $10,000 are non-deductible expenses, then your employer is going to have to gross up your W-2 by $10,000 and subject you to all the taxes that go with that. Non-taxable fringe benefits. There are some that are non-taxable, can be given to an employee and excluded from that employee's income. Examples of non-taxable fringe benefits include services provided to you by your employer at no cost to your employer, qualified employee discounts, working condition fringe benefits that are the cost of property or services you could deduct as a business expense if you had paid for it. Examples include business use of a company car and subscriptions to business magazines. So earlier we said a taxable fringe benefit includes personal use of a company car, but business use of a company car is a tax-free fringe benefit. And the reason it's tax-free is that if you used your own car, you would be allowed to deduct the cost of operating it for business purposes. Also, certain minimal value fringe benefits, and examples of minimal value fringe benefits are an occasional cab ride paid for by your employer when you must work overtime, local transportation benefits provided because of unsafe conditions and unusual circumstances, meals provided at eating places operated by your employer if the meals are not furnished at below cost, and qualified transportation fringe benefits subject to special conditions and dollar limitations, including a ride in a commuter highway vehicle between the employee's home and place of work, transit passes, qualified parking, and qualified bicycle commuting reimbursement. For 2011, federal law allows the exclusion of benefits up to the following limits: $120 per month for combined commuter highway vehicle transportation and transit passes. So what this is saying is if you have an employer who gives their employees transit passes to take mass transit to work, that the employer can do that and give it to the employee as a tax-free fringe benefit as long as the cost is $120 per month or less. If the cost is more, and let's just say it costs $200 a month for the employer to give you that transit pass, then the $80 difference has to be grossed up in your W-2. We also have a limit of $230 a month for qualified parking. Now, if you work for an employer in a downtown core area where parking is expensive and has to be paid for, it can really put a dent in your wallet. And employers are allowed to provide free parking to you to pay for that parking expense for you. And if they do so, though, anything above and beyond $230 a month is a taxable fringe benefit to you. Now, interestingly, if you are self-employed, you are never allowed to claim parking as a business expense on your Schedule C for the daily commute parking. If you have business parking because you were traveling for business purposes, that can go on Schedule C, but if you are an but you can't claim the cost of commute parking on your Schedule C. The only time commute parking is deductible is when an employer pays commute parking expenses for an employee, and in cases where that commute parking expense goes above $230, the employer is going to have to gross up the W-2. And finally, they have a little token amount here of $20 per qualified bicycle commuting month. Also, an employer can exclude qualified moving expense reimbursements, the use of on-premises athletic facilities if substantially all of the use is provided by employees, their spouses, and their dependent children. Or provided by all of the use is by employees, their spouses, and dependent children. Qualified tuition reduction in an educational organization provided to employees for education. And if you want to know more about taxable fringe benefits and non-taxable fringe benefits, you should go to IRS Publication 15B, which is everything you wanted to know about fringe benefits. And my opinion is that one of the IRS tests that I think is going to come up next, because right now they're working on the RTRP test, That's the test that everyone's worried about, everyone's going to be studying for and trying to pass. That's the first in a series of tests that the IRS intends to introduce. Other tests that they have in line that they have discussed are payroll law tests, partnership tests, and corporation tests. So when we get into payroll rules, this is some example of some of the things that I think would come up on a payroll test. This is a table from Publication 15B that talks about the various types of fringe benefits and whether or not they can be excluded from income, and if they can be excluded from income, the extent to which they can be excluded from income. One of the big ones here is employee stock options. These are relatively not so common these days. They were more common in the 90s. But employee stock options are, actually, this is not a true statement. There are qualified and non-qualified stock options, and the qualified options tended to be issued more in the 90s. These days, in the 21st century, right, we see more non-qualified options, or we see other things like restricted stock units or employee stock purchase plans. And all of those kind of quasi fall into this definition of employee stock options. And what the IRS says is that if an employer gives an employee stock in the company as a reward or a bonus for services provided, that stock has to be grossed up on the W-2 as a wage. It's a fundamental aspect that a lot of people don't grasp, a lot of tax preparers don't grasp. So anytime you have a client who comes in and they have a W-2 that has a code V in box 12, that means that they exercised stock options. Even if they don't have a V in box 12, they could still have exercised stock options. So we actually get into stock options and how gross ups happen on W-2s much later in our series when we get into basis of assets and sale of stock and other assets. There are some exceptions here to the fringe benefit rule. If the employer provides lodging on the business premises, it can be exempt to the employee if it is furnished to the employee at the convenience of the employer and as a condition of employment. So I'm not going to read through all of these. It would just take too much time, and it is a whole course all by itself, but I did want you to have the table in the manual and be able to refer to it. The next topic we're looking at is tip income. All tips you receive are income and subject to income tax. If you receive tips, you should keep a daily tip record, report tips to your employer, and report all of your tip income on your tax return. Now, do you think there's a few people working as servers or waitresses in restaurants that think their tips are tax-free? That's why we have allocated tip laws, because it's so easy for a server to pocket money, not report it to the employer, and who would know? So the IRS looks at gross receipts of restaurants and says, well, if you have $100,000 in sales, you should have employees reporting into you at least 8% tips on those sales. And if you're only getting 6% reported in, time to do an allocation and allocate everybody so that the tips reported on their tax return are at least 8% of the sales from the restaurant. So the way employees fight this is by keeping a tip log. It could be you're just a really terrible waiter, or you're working in a restaurant that almost no one tips in. It's possible that you would fall under 8%, but I think pretty much the norm I see when people tip is a low of 10%, and 20% is the norm. I know I always tip at 20%. So, if they got a waiter saying that they're not getting even 8%, or an entire restaurant saying they're not pulling in 8%, that's what they're looking at. So what the worker is supposed to do, what the server is supposed to do, is maintain a tip log. There are two methods that the IRS accepts for tip logs. One is to write information about your tips in a tip record, and the other is to keep copies of documents that show your tips. Examples include restaurant bills, credit card, and charge slips. If your employer uses an electronic tip record, you must receive and keep a paper copy for your records. Why report tips to your employer? Well, because you're required to under the law. That would be the first reason, but there's others. One of which is that your employer will be able to withhold income, Social Security, and Medicare taxes. And your employer can correctly report your earnings to Social Security Administration, thereby boosting up the amount of Social Security you can qualify for. And 3, to avoid the penalty for not reporting your tips. Allocated tips are amounts that your employer assigns to you in addition to tips reported, and your employer is required in certain situations to allocate these tips to you. So let's take a look at an illustration here that I created. In our illustration, we have Betty. She received a W-2 from her employer showing the following information. Box 1 wages of $7,000, and Box 1 is comprised of two separate boxes, Box 3 and Box 7. She doesn't have a pension plan or anything pulling down her Box 1 wages. Her Box 1 wages is essentially the total of Box 3 and Box 7. Box 3 is her Social Security wages, and Box 7 is her Social Security tips. And then, but in her Box 8 of her W-2, there's an allocation there of $4,500. Now, Betty was very careful throughout the year and kept a tip record. Her tip record shows that she received $5,000 in total tips for the year. Betty was naughty, however, and only reported $3,000 of her tips to her employers. That's this $3,000 right here. So she pulled in 5, reported 3, and then her employer allocated $4,500. So the $4,500 would be on top of the 3, right? But the actual amount she really received was $2,000 on top of the 3. So her W-2 identifies $3,000 of tips in Box 7. She should have reported 5, in which case Box 7 would have had $5,000 in it. Now, since Betty underreported tips to her employer, she is required to file Form 4137 to calculate and report the Social Security and Medicare tax she owes on $2,000 of tips that she received but did not report to her employer. When filing her return for the year, Betty should report total wages of $9,000 on Form 1040, line 7 as follows. So Box 1 wages on the W-2 right now currently shows $7,000, but she had $2,000 of unreported tips. So when she fills out line 7 of her tax return, she's going to enter $9,000, even though her W-2 shows $7,000 in Box 1. So Betty's tip record is proof of the actual tips that she received for the year, so she is allowed to enter only $9,000 on line 1. If she didn't have a tip log, how much would she have to report on the line 1 of her 1040 instead, or line 7 of her 1040 instead? It would be $7,000 plus $4,500. So her allocated tips are $4,500. The wages already showing in Box 1 are $7,000, so she would actually have to report $11,500 on line 7, the wage line of her tax return. But she has a tip log, so she's going to be able to report a lesser amount of 9. So when you're looking at a W-2, I'm just going to flash back up to that W-2 again. Let me get there. One of the reasons I went over the W-2 at the start of this class is just so you can have an image of it in your head while I'm talking to you. But Box 1 is the line number that will carry to line 7 of your tax return. Line 7 on 1040 being where you report wage income. IRS says anything that is the equivalent of wages gets reported on line 7 of your tax return as wages. And if Betty does not keep a tip log, she's going to need to take line 1 and add to that the amount in Box 8, her allocated tips of $4,500, and the total of those two amounts will carry to line 7 of her 1040. Because she kept a tip log, she can ignore the amount in Box 8 and instead enter on her tax return Box 1 of her W-2 plus the actual amount of tips she can prove that she really received, which was another $2,000. So I've actually gone here and filled out Betty's W-2 for you so you could see what's going on here. So line 1 of the W-2 is showing $7,000. And line 8 is showing $4,500. She kept a tip log, so the amount that we're going to enter on line 7 of page 1 of her Form 1040 is going to be $9,000. 7 plus 2, $9,000. She received a total of $5,000 of tips. She reported $3,000 to her employer, and that $3,000 is included in Box 1. So the amount not included in Box 1 is an additional $2,000. And that's how we get $9,000 on line 7. There's a question about 4137. Be patient, I'm getting there. So obviously, since she has unreported tip income, she has to fill out Form 4137 to report that tip income. And I've got it coming up next. So Betty works for Jake's Pub and Grill. And the total cash and charge tips that she received for the year, that she can prove she received for the year because she kept a tip log, is $5,000. And how much did she report to her employer? She reported $3,000. 5 minus 3 equals 2. Then we look at some other computations going on here, one of which is the maximum amount of Social Security income you can have, or maximum amount of earned income you have subjected to Social Security tax before you max out on the Social Security tax you need to pay for the year. And it's $106,800 of wage income that you are allowed to earn before you max out. And this formula right here, line 7 minus line 8, is just used to establish whether or not Betty has maxed out. And clearly she's a long way from maxing out. So what that means is that all of the $2,000 of unreported tip income is going to be subject to Social Security and Medicare tax. And on line 11, we calculate the Social Security component, which is 4.2% times 2,000. And on line 6, we take 2,000 times 0.0145%, and we get $29. And you total those two amounts up, you get $113. And the $113 carries to line 57 on page 2 of Betty's Form 1040. Now there's one other point I need to tell you about tip income. It comes up on our tip quiz, and it is a question certainly that could come up on any kind of tax exam. The rule for reporting tips is that if you receive $20 or more in tip income in any one month from any one employer, you are required to report tips for that month on Form 4137, which is the tip tax form. How much tip income are you allowed to receive before you have to report it on line 7 as wage income? It's a question I'm asking you, my audience. Who knows the answer? $1. Thank you, Linda. So it's possible to work for an employer and receive $15 in tips for the month. You're not going to have to fill out Form 4137 to pay tip tax on it, and you're also not even required to report it to your employer. But it's still taxable and still needs to get reported on line 7 as wage income. Okay, the next category of wage we're going to look at is taxable scholarship and fellowship income. A scholarship or fellowship that you receive to pay for your college education is tax-free only if you are a candidate for a degree at an eligible educational institute and you use the scholarship or fellowship to pay qualified educational expenses. A scholarship is not taxable to the extent it is used to pay qualifying expenses, and the following expenses are qualifying expenses. They include tuition and fees required to enroll at or attend an eligible educational institution, as well as the cost of course-related books, fees, supplies, and equipment that are required for the courses at the eligible educational institution. But these items must be required of all students in your course of instruction. So maybe you need a laptop computer for school. Can the laptop be a qualifying expense? The answer is, does the educational institution require all students to have a laptop for attendance at that course? If the answer is yes, then it would be a qualifying expense. But expenses that do not qualify are room and board, travel, research, clerical help, or equipment and other expenses that are not required for enrollment in or attendance at an eligible educational institution. Now, if you have a taxable scholarship, what you would do is you would go over to your Form 1040, and on the dotted line next to line 7, you would type SCH for taxable scholarship. So I'm just going to open up a 1040 form here real quick and show you what I mean by that. Let's do this. Just want to get me to the IRS website and find a 1040 form. Whenever you take my classes, it's a good idea to have the form handy next to you so that when I'm referring to line numbers on it, which I frequently do, that you can just refer to the form. So here I've called up the Form 1040. We're talking about line 7 wages, And what IRS wants you to do is in this space right here on the dotted line next to line 7, type SCH to tell the IRS that you're including taxable scholarship in the amount entered on line 7. Yes. There's a question in the classroom, how do you figure out essentially how much of a scholarship is taxable? Well, let's just suppose you've received a scholarship for the year that is $20,000. And the cost of tuition for attending that institution for the year is $15,000. So right now you've got $5,000 that you're figuring out how did you spend that? Did you spend it on qualifying expenses like books, supplies, and equipment? So you would need to start listing the cost of all of those items. Now books are pretty expensive, and if you purchased yourself a nice Apple computer, it wouldn't be hard to use up $5,000 in a year. But you're going to have to be able to document that. And let's suppose, try as you might, the best you can do is document another $3,000 of qualifying expense. So you're able to come up with $18,000 of qualified expense on a $20,000 scholarship. You're going to enter SCH on line 7 of Form 1040 and include $2,000 of taxable scholarship as line 7 wages. Session 3, password number 2 is BLUE, B-L-U-E. All right, so we've got interest and dividend income is the next topic of the day. And depending on the amount of interest and dividends you have, you may or may not be required to file Form Schedule B. And the magic number for income-wise on interest and dividends is $1,500. So if you hit $1,500 of interest and dividend income, then you need to attach a Schedule B to your Form 1040 or your 1040A. But even if your dividend and interest income is less than $1,500, you may still be required to attach Schedule B if any of the following apply. And of course, Schedule B is used to identify the payors who are issuing you interest and dividend income, but also to answer other questions as well. So you need to file Schedule B if any of the following is true. Number 1, your taxable interest or ordinary dividend income is more than $1,500. You are excluding interest under an education savings bond program. You had a foreign bank account. There's a checkbox on the form down at the bottom of the form. Have any of you ever noticed it? Tax software is pretty much demanding that you fill it out. At least our software is not letting us save a tax return as final and complete until we've answered those checkbox questions. So those checkbox questions ask, do you have a foreign bank account? A homeowner paid you interest under a seller-financed mortgage. So let's just say you sold your home under a seller-financed mortgage and the people who bought the home from you are paying you interest on that loan. Then you are required to attach a Schedule B to your tax return to identify the name, address, and, well, the name and at least the name and social security number of the party that's paying you. Number 5, you received Form 1099 INT for U.S. saving bond interest for amounts that you reported before 2011. Number 6, you received nominee interest or ordinary dividends from someone else. Number 7, you received a Form 1099 INT for interest on frozen deposits, or you received a 1099 INT for interest on a bond that you bought between interest payment dates, or you were reporting original issue discount in an amount less than the amount shown on Form 1099 OID, or you acquired taxable bonds after 1987 and chose to reduce interest income from the bonds by an amortizable premium amount or bond premium. Now, the most common reasons why I see Schedule B has to be attached is simply we hit this $1,500 figure, but foreign bank accounts are actually quite a few people have them. And the other reason I run across occasionally is homeowner paid you interest on a seller-financed mortgage. Those are the most common reasons that I see Schedule B is required. So interest income, we're just going to look at some definitions now, beginning with what exactly is interest income. Interest income is income that you receive from money you leave on deposit in a bank or credit union or from money that you loan to others. Money market mutual funds also pay interest income. Dividends that actually are interest. IRS wants you to note that so-called dividends from deposits you have with credit unions or savings and loans are actually interest and must be reported as interest income. And I frequently find my clients are confused by this. I'll ask them what they receive for interest income, and they won't tell me about their credit union dividends because they think that that's dividend income. And they talk about, yeah, these are the dividends I got from my credit union, but dividends from a credit union are interest. It's a very different animal than actual dividends. Gift for opening an account. If you receive a gift from a bank valued at more than $10 and you have less than $5,000 on deposit, then you must include the gift as interest income. For deposits of $5,000 or more, you must report as interest income gifts of more than $20. Interest on insurance dividends. Interest on insurance dividends left on deposit with an insurance company that can be withdrawn annually is taxable to you in the year it is credited to your account. However, if you can withdraw only after the anniversary date of the policy, the interest is taxable on the date that that actually occurs. Prepaid insurance, any increase in the value of prepaid insurance is interest income if it was applied to the payment of the premiums due on those insurance policies. The next thing we're going to talk about is interest on U.S. government obligations. And it surprises me how few tax preparers ever even pay attention to what kind of interest is being reported on a 1099 INT. I'm actually going to pull up a 1099 INT for you real quick here. Just flashed by it. Now, like the W-2, this 1099 INT represents basically the generic format that the IRS creates. And if you go to the IRS's website and say, I want to look at a 1099 INT so I can fill one out, this is what they look like. But you almost never see a bank statement that looks like this. Or a bank 1099 INT coming to you that looks like this. Typically what they usually say is they'll say substitute 1099 INT. Interest reported in box 1 and they'll have a number. Interest reported in box 3 and they'll have a number. Interest reported in box 8 and they'll have a number. And it's your job as the tax preparer to go, oh, box 1 equals ordinary interest. Box 3 equals U.S. savings bonds. Box 8 equals tax-free state bond interest. As tax preparers, it's your job to simply know that information. It shouldn't ever be a case that you look at a substitute 1099 INT, see a box number referred to, and you don't know what that box number means. You should just know it. So when I'm talking in my class and I say box 3 interest, what do I mean? Say it. Huh? U.S. government interest. What's special about U.S. government interest? Exempt from what? It's exempt at the state level. The states aren't allowed to tax it. But it's also relevant because if you cashed in U.S. savings bonds, you might be able to exclude interest on those bonds if they were spent on higher education expenses. So there's a couple of reasons why U.S. bond interest is relevant, but this mostly has to do with the state tax return. So U.S. bond interest is important. It's separated out from all other forms of interest and is identified in box 3 of the Form 1098, or pardon me, the 1099 INT. It is not taxable at the state level, and if you are filing a state tax return, you may need to enter a subtraction on your state tax return to subtract that interest income out so that it doesn't get taxed. Then we have that you may be able to exclude the government interest from your income if you paid qualifying educational expenses during the year. To see if you qualify for this exclusion, see the instructions for Form 8815. By the way, the married filing separate status cannot exclude interest on U.S. government bonds. There are typically 3 different kinds of U.S. government obligations. They're divided into Treasury bills, Treasury notes, and T-bonds. And generally, the bills have a maturity period of less than 1 year, are issued at a discount, and the difference between the discounted price you pay and the face value of the bill at maturity is interest income to you when the bill matures. Treasury notes generally have a maturity period of 1 to 10 years. Interest is usually paid every 6 months and is reported as income in the year you receive it. And finally, Treasury bonds typically have a maturity period of more than 10 years. Interest is usually paid every 6 months and is reported as income in the year you receive it. And we've got Series HH and Series EE bonds. And the relevance of these bonds is that the very first year in your life where you ever purchase a U.S. savings bond, you make an election at that time on how you're going to report the interest. You make an election under Method 1 or under Method 2, but the election must be made the first time in your life that you ever acquire these bonds. Interest on these bonds is payable when you redeem them. Series EE bonds are issued at a discount. You can choose to report income from Series EE bonds when they mature, which is Method 1 and the method that most people use, or you can choose to report the increase in redemption value as interest each year under Method 2. Once you start reporting your interest income under a particular method, you must use the same reporting method for all future bonds you own in your lifetime. Series I bonds are a little bit different. They were first issued in 1998, and they are intended to encourage taxpayers to save more by offering inflation-adjustable interest rates. The bonds are comprised of two parts. Number one is a fixed rate of return that remains the same for the life of the bond, and the other is a semi-annual inflation rate that can vary every 6 months. And Series I bonds mature after 30 years. And again, you have to choose which method of reporting interest you're going to use the very first year you ever buy the bonds, any bonds in your lifetime. Okay, installment sale payments. An installment sale happens again when you sell property you own, usually a house, to a buyer. And that buyer is paying you payments on an installment basis. If you sell your property on a contract to receive payments over time, then you have an installment sale. You have an installment sale as soon as a payment is paid in more than 1 year. So if you sell your house and they're going to pay 50% down this year and the other 50% next year, that's an installment sale, even though there were only 2 payments. Now, if you have an installment agreement and that agreement fails to provide written terms for the interest amount of the contract sale, then the interest portion of each payment will generally be implied. Interest is taxable when you receive it, and as far as the IRS is concerned, you're not allowed to choose to give someone an interest-free loan. And this occurs not just in a business transaction where you're selling property to a third-party person, but also if you're, loaning money to relatives. And let's think a little bit about why this might be. If you sell property on an installment sale, let's say a house worth $200,000, there could be an incentive for the seller to have 0 interest, so that all of each payment is treated as capital gain income, which is taxed at a much lower rate. But IRS says you cannot give an interest-free loan, and therefore part of every payment has to be interest. For the buyer, having part of each payment be interest is a good thing. They get to deduct it on their tax return. But it may be a bad thing in that each payment is going some to interest and some to principal and not all to principal. But IRS says if you are the seller, interest is going to be implied whether or not the agreement has the interest reported in there. And so if you're audited and you have an installment sale and you have not been reporting interest from that installment sale because the contract didn't provide for it, then the IRS can come along and construe what the rate of interest is that you should have been, that they deem that you have received, and force you to report that and pay tax on it anyway. The flip side of the equation would be, let's just say you got grandma and grandpa, and they're pretty rich. They're worth a few $1,000,000, and they've got, the grandchild here, and they'd like to be able to help this grandchild buy a house. And so they say, what we'll do is we'll give you an interest-free loan to buy this house. IRS is saying, can't do that. Well, you can give the loan, it just can't be interest-free. And why would IRS care about that relationship? Well, what they would be looking at is that each year you are allowed to gift another person up to $14,000 and not have to report that as a gift or pay any gift tax on it. So if you've got rich people trying to indirectly loan money to avoid these gift tax rules, IRS is going to be all over that as well. So that's 2 reasons why interest is always interest income and will be implied when you don't stipulate what it is and enter it on the tax return. Now, if you are a beneficiary of an estate, trust, S corporation, or partnership, you will receive a K-1 in most cases, and that K-1 is going to report income on it. If any of the income reported on that K-1 is interest income, you're going to flow that interest income through to your personal return and enter it as interest income on line 8 of your Form 1040. So, of course, line 7 is where we report wages, and line 8 is where we report interest. So here's the 1040 form, and we have line 7, wages. That's where we enter wages, taxable scholarship, allocated tips, unreported tips, all go on line 7. Line 8 is the line that we're talking about now, and line 8 is where we enter interest income. If we receive tax-exempt interest, that is interest reported in box 8 of the 1099 INT, we'll enter tax-exempt interest on line 8B, and all other forms of taxable interest get entered on line 8A. The next item that we're going to talk about is dividend income, and dividend income is, of course, reported on line 9A. But any portion of the dividend income that is qualified dividends is reported on line 9B. And the amount on line 9B is included in line 9A, but the amount on line 8B is not included on line 8A. Got it? So 8A is taxable interest, 8B is non-taxable interest, 9A is taxable dividends, 9B is the portion of 9A that is qualified dividends. And if you have qualified dividends showing on line 9B, using the tax rate tables in Form 1040 instructions, so you go in Pub 17 and you flip to the back, here's Pub 17, and we flip to the back and we have these tax tables where you figure your tax, right? You can't use these tax tables exclusively when figuring your tax if you have qualified dividends. Because qualified dividends are taxed at a maximum rate of either 0% or 15%, and these tables are going to give you tax at a higher rate. So anytime you have qualified dividends, you're going to have to do a qualified dividend and or capital gain worksheet to figure the amount of tax you're going to owe on those qualified dividends. So let's go back. That can happen. Okay, so that's what I had to tell you about interest income. Well, we had the 1099 INT up a minute ago. Let me show it to you again. You'll see that there's a big bold box around box 4. That's where you enter federal income tax withholdings, or whether the payor enters federal income tax withholdings. And really, for all the history that I've been doing tax returns, it's nearly always blank. But I am starting to see more and more people with withholdings going on there. And the reason that there will be withholdings there is if the payor, the bank or institution, submits a 1099 INT to IRS, and IRS comes back to the institution and says there's a mismatch between the Social Security number of the filer and the name of the filer, or in this case the recipient, that the payor needs to send a notice to that filer asking them for the corrected information. And if the filer fails to respond, then the payer is required to do backup withholding. And this is not a new law, it's just a law that the IRS is now quite aggressively beginning to enforce. It's an area of enforcement, and the reason it's an area of enforcement is because of Obama's new Health Care Act. Part of what happened when the Health Care Act was created was that the government needed to come up with money to fund the new programs. And one of the sources of money was to close the tax gap. The tax gap being people who owe money and aren't reporting it and paying tax on it. So they're looking for ways to burrow in on people who have income coming in, are not reporting it, not paying tax on it, and it's being turned, the responsibility for some of that collection effort is being turned over to payers like banks and businesses who need to be responding to IRS orders to do backup withholding. And you will be required to do backup withholding if you have a mismatch between a name and a Social Security number on a document you file with the IRS that shows payments to someone that you made payments to. And if there's a mismatch, IRS sends you a letter and says, there's a mismatch. Send out something called a B notice to the recipient and tell them you have a mismatch. Ask them to complete a W-9 form and resubmit it to you. If they refuse to fill out the W-9 form, or they give you another bad number, or they fail to respond altogether, backup withholding will start. So I have observed over the last few tax seasons, just the last couple in fact, that I'm starting to see clients who have backup withholding where there never used to be any. And it's simply because they've ignored letters. They get a letter from the bank saying, you need to fill out this W-9 form and give it to us. And they go, I'm not filling out a W-9 form and giving it to my bank. They refuse to fill it out, and presto, they've got withholding. When it comes tax time, that's not necessarily a bad thing. It might help eliminate any amount that they owe, right? So it does serve a purpose. And of course, if you have foreign tax that was paid, that's relevant. Foreign tax paid is a credit that you can claim on your federal return. So with that, let's move on to dividend income next. And on dividend income, I'm now going to be showing you the 1099 DIV. It looks a little bit like an INT, of course, but it has different boxes and different definitions. Box 1A is where ordinary dividend income is reported, and box 1B is qualified dividends. Box 1B is included in box 1A. So often box 1A and box 1B are equal, and sometimes box 1A is a larger number than box 1B, but you should never have B being bigger than A. Box 2A is where capital gain distributions are entered. You typically have that when you're dealing with mutual funds. The mutual fund will buy and sell stock internally, and when stock is sold at a profit, it triggers capital gain, and those capital gains become a capital gain distribution on the 1099 DIV. We also have unrecaptured Section 1250 gain. That means that real estate, real property like an office building has been depreciated, it's been sold, and there's been a recovery of depreciation that's claimed, and that's unrecaptured Section 1250 gain. Unrecaptured Section 1250 gain is subjected to a maximum capital gain rate of 25% versus 15% for other forms of capital gain. There's also something here called Section 1202 gain that can get some special treatment, and collectibles gain. Sale of collectibles at a gain can produce a maximum tax rate of 28%. Again, we have federal income tax withheld in box 4. In box 3, you'll see non-dividend distributions. Non-dividend distributions are generally a return of capital. They reduce your cost in your stock, but are not typically income. There's also something, I've just scrolled down a few pages. I'm on page 29 or 30 now. Insurance dividends. Dividends you receive from your insurance company that are a return of premiums or are used to pay premiums are not taxable until they exceed the total of all net premiums that you have paid. However, if you receive interest payments on these dividends, that interest is taxable as interest income. I'm going to talk about something new now called nominee interest and dividends, and I run across very few tax clients and tax preparers who have any concept of what a nominee amount is or how to report it on a tax return, but it is actually pretty common. Your Form 1099 DIV or 1099 INT might include amounts that belong to another person. If it does, you are considered to be a nominee recipient, and you report the full amount of interest and dividends on the Schedule B on your tax return, even if the Schedule B is showing, or the 1099 DIV is showing money that belongs to someone else and not you. So how would that happen? Well, the most common situation I can see that happen is a parent might have a bank account with a good amount of money in it, maybe $100,000. And they want to make sure that their child, their adult child, will have free and easy access to that money when they die. They don't want to have it go into probate. So they essentially open the account as a joint account, or maybe it was a single account that they added their child to later on. Okay? And if it works out that that child is made the primary account holder, even though the money belongs to the parent, then the primary account holder is typically the one that's going to get the 1099 INT, but it's going to be for money or income that's not theirs. It really belongs to the parent. So that's an example of how that could happen. You could also have it where a child opens up an account and the parent opens up the account in the child's name, and the parent's name and Social Security number on the account next to the child's. Now the child has income, but it's in the parent's Social Security number. So what do you do when you have income being reported under your name and Social Security number that isn't really yours? Well, you don't want to have to pay tax on it, or maybe you will just pay tax on it because you don't have a problem with it. But if you don't want to pay tax on the money because it's not your money, there are procedures that you have to follow. And here's an illustration of what I mean. Galadriel and her sister Arwen are joint owners of savings and investment accounts at Rivendell Community Bank and Two Towers, Inc. Form 1099 INT and 1099 DIV were issued to Galadriel by both of these financial institutions, even though the money and interest income in these accounts belongs to Arwen. Galadriel also received a 1099 INT from Rohan Bank, but the Rohan Bank 1099 is actually her income. It's not joint income or nominee income. So here we have the Rivendell Community Credit Union, and we'll see it's got $1,200 of interest income being reported in box 1. This $1,200 of interest income is being reported to the IRS under Galadriel's name and Social Security number. She has to report this income on her tax return and cannot ignore it, even though it's not her money. Now we have a second 1099 INT. This one is from Rohan Bank, but this one really is Galadriel's money. So this also is going to get reported on her tax return as interest income. And then finally we have a third document. This one is a 1099 1099 DIV from Two Towers Inc. And the Two Towers Inc. 1099 DIV is again income that belongs to Arwen, but is being issued in Galadriel's name and Social Security number. So what is Galadriel going to do with this on her tax return? Well, we're going to go over and fill out a Schedule D or Schedule B for Galadriel. And the first thing we do is acknowledge all forms of interest income she received during the year. We have Rivendell Community Bank that paid her $1,200, and we have Rohan Bank that paid her $800. And it's actually buried under this box. You can't see it, but there's another $800 that's appearing on this line. The interest subtotals at $1,200 and at $2,000. So $1,200 plus $800 equals $2,000. We then subtract out $1,200 as a nominee distribution made to Arwen, and ultimately Galadriel will report $800 of interest income that was received and is actually her interest. And this amount will carry to line 8A of her Form 1040. Now Galadriel also received income from Two Towers Inc. in the amount of $500, but in this case all of the dividend income needs to be nominied out to Arwen. So we're going to take out $500. We have $500 up here. We subtotal the $500. We subtract out $500, and we end up with 0 here on line 6. And then, of course, we have to go through and answer these Part 3 foreign trust and account questions. Let's just zoom in to see what those say, because they are mandatory questions. You're not allowed to leave them blank. And they say, at any time during 2011, did you have financial interest in or signature authority over a financial account, such as a bank account, securities account, or brokerage account located in a foreign country? Well, we've answered no. Box B, are you required to file TDF 9022.1? Yes or no? What is that form? Who knows? This is something that the IRS is hot and heavy all over. As a tax preparer, you should know what the form is and when it's required. So I'm going to tell you about that next. Wait for the exciting details. And then, during 2011, did you receive a distribution from, or were you the grantor of, or transfer to a foreign trust? Yes or no? Answer yes or no. So we have to answer those questions for Galadriel, and then we move on to what happens next. Well, Galadriel is nomineeing interest and dividend income to Arwen, so she has to issue Arwen a 1099 DIV and a 1099 INT. So I've done that for her. Galadriel is now the payer, and Arwen is now the recipient. And that $1,200 of interest income is being transferred over to Arwen. So it came in on Galadriel's Schedule B, it's nominied out on the Schedule B, and the final step is to issue Arwen a 1099 INT for the nominee amount. We repeat that process for the 1099 DIV, and remember we're maintaining character. It was ordinary dividends that came in and ordinary dividends that go out. Session 3, password 3 is TANG, T-A-N-G. Please flip to page 33 of your Session 3 student manual to the classwork assignment that involves preparation of a tax return for John Walker and his wife, Donna. John Walker and his wife, Donna, live together. Donna is blind and has no income of her own. John is a bartender. He regularly receives cash tips and does not report them to his employer, as he should. John does not keep up a tip log, as he should. John received a substitute 1099 INT with Box 1 interest of $300, Box 3 interest of $200, and Box 8 interest of $50. He also received a substitute 1099 DIV with $200 of ordinary dividends shown in Box 1A. So if you're not sure what those boxes mean, maybe you should flip to the pages that have images of the 1099 INT and the 1099 DIV and refer to them as you're preparing this particular tax return. John's W-2 is attached. Prepare the Walker's federal return. And as you're getting started on this particular tax return, I wanted to show you that we have a W-2 showing $25,000 of wage income, of which $18,000 is wages and $7,000 is tips. In addition, Box 8 shows allocated tips in the amount of $5,000. At this time, please push pause on video playback. Prepare a tax return for the Walkers. The forms that you will need to prepare as a part of this tax return include Form 1040 and Form 4137. When you are finished preparing the tax return for John and Donna Walker, please resume video playback for a review of the classwork answer key. So assuming you have now finished preparing the tax return for the Walkers, you can now watch this portion of the class, which will review the answer key for the Walkers tax return. John Walker was age 64 on the last day of the year 2011, and neither he nor his wife Donna qualifies for an additional standard deduction for being age 65 or older. However, Donna is blind and she will qualify for the additional standard deduction for being blind. John received $5,000 of allocated tips and did not keep a tip record, so he will need to complete Form 4137 to pay his share of Social Security and Medicare tax that is owed on the additional tip income. So let's start this return by taking a look at the 1040 for John and Donna. Once we've looked at a few line items on the 1040, then we'll take a look at preparing Form 4137. But to begin with, we enter their names, their Social Security numbers. The filing status, box 2 is checked for married filing a joint return. We've checked exemption boxes in 6A and 6B. And the total number of exemptions is 2, which carries down to line 6D. Then on line 7, we enter $30,000. Well, you might be asking, where did you get $30,000? Well, maybe you figured it out and maybe you didn't. The answer is that although the W-2 says box 1 wages are $25,000, because John Walker did not maintain a tip log, he is going to have to include all $5,000 of allocated tips in his income as wages. So $5,000 plus $25,000 gives us the $30,000 that needs to be reported on line 7. On line 8A, we enter the amount of interest that he received, and we know how much interest he received by the substitute 1099 INT that he received. Box 1 interest is $300. Box 3 interest is $200. Well, box 3 interest is U.S. bond interest, and box 1 interest is ordinary interest. Both of those amounts are fully taxable on the federal return. $200 plus $300 is $500, and that's what we enter on line 8A. Box 8 is used to report tax-exempt interest. Tax-exempt interest is not included in adjusted gross income, but it is reportable on line 8B. That's where we've entered it, $50. We add up lines 7, 8, and 9 and enter the total on line 22. That's $30,700. There are no adjustment items, so the adjusted gross income and the total income are the same amount, $30,700. Flipping over to page 2, line 38 picks up where line 37 left off with the adjusted gross income. The next step is to check on line 39A whether any of these requirements are met for being age 65 or blind. And for the spouse, we will check the blind box and enter a total of 1 on line 39A. Next step is to go over to the amount of standard deduction for a married filing joint couple. That starts at $11,600, but we are going to add $1,150 to that total, making the total amount on line 40 $12,750 of standard deduction. We subtract the standard deduction from the total adjusted gross income, and we get $17,950. The next step on line 42 is to enter the exemption deduction. The Walkers will get an exemption deduction of 2 times $3,700, which equals $7,400. We subtract $7,400 from $17,950, and we're left with $10,550 of taxable income. The next step is to go to the tax tables in Publication 17 to look up the tax. The tax that you should get for a married filing joint couple with $10,550 of taxable income is $1,058. Now we come down to line 57, and we're going to need to complete Form 4137 to figure the amount of tip tax to enter there. You can see that our entry is $283, but let's show you where we got that. Firstly, an explanation. John Walker did not report any of his cash tips to his employers. He is therefore required to file Form 4137 to pay his half of Social Security and Medicare tax on his allocated tips. We have filled out the form. Line 1C is probably the more complicated of the lines to figure out. And to do that, we start with his allocated tips in Box 8 and add those to the Social Security tips that he received. That's $12,000. So the starting point on Form 4137, we look at line 1, and the description is tenders bar and the employer identification number. And we got that from the W-2 showing right here. On line C, we're going to enter that $12,000 of total tips received for the year. And in Box D, we're going to show the amount that was reported to the employer. Now, even though the wording says that Johnny does not report tips to his employer, you might be wondering how tips got reported. Well, if there's charge and credit card receipts, the employer is going to be able to pull those amounts out and know what they are and include those in wages. But when an employee receives cash tips and does not report those, that's where there can be this difference. And that difference is $5,000 moving over to Box 8. Line 2, total up the total tips received. Line 3, enter the total amount reported, subtract them out, and get that $5,000 difference. We then have an equation going on here on line 7. You'll see that it says $106,800. If Johnny had enough other sources of earned income from self-employment or other jobs, it's possible his income would be more than $106,800. And if it were, he would not be subject to Social Security tax on some of his tips. In this case, his income is well below that threshold, so all of his tips are going to be subjected to tax. Ultimately, $25,000 is the amount of income that he has already paid Social Security tax on. He's going to now pay another. He's going to pay Social Security and Medicare tax on an additional $5,000. The Social Security portion of that tax is $210. We simply take $5,000, multiply that by 0.42. We then take $5,000 and multiply that by 0.0145 and get $73. The total of those two numbers is $283. And we take that back up to line 57 of the Form 1040 and enter it there. Do not forget to check the box for Form 4137. The W-2 in Box 2 shows $2,000 of federal withholding. That $2,000 carries over and is entered on line 62. And then on line 72, we carry that total down. We subtract $1,341 of total tax. That's $1,058 plus $283 is $1,341. We subtract that $1,341 from $2,000, and we end up with a refund due to the Walkers in the amount of $659. So that concludes the review of the Session 3 classwork assignment. It's now time to review the Session 3 homework assignment so you can be on your way. At this time, please flip to page 34 of your student manual to review this assignment with me. The assignment again involves preparation of two forms, 1040 and Form 4137. Our character this time is Jackie Rhodes, who lives in Portland, Oregon. Her husband, Jonathan, died in 2010, and Jackie has not remarried. She has two children living with her whom she supports. Her daughter, Kathy Lee Rhodes, and her nephew, Sammy Smith, both lived with her the entire year. Jackie receives a 1099 INT from National Bank with Box 1 interest of $100, Box 3 interest of $300, and Box 8 interest of $300. Jackie is a teacher, and she also is a server on weekends at Alice's Bar and Grill. She did not report any tips to her employer and does not keep a tip record. Her W-2s are attached to prepare her federal return. Her first W-2 is from the Board of Education, showing $42,000 of wage income. The second W-2 is from Alice's Bar and Grill. And again, you will see she's got allocated tips down here of $1,275. And this concludes Session 3 of the Basic Tax course. Of course, you have your assignment for Jackie Rhodes to complete for homework. When you come back at the beginning of session 4, remember that the first item we will cover in session 4 is a review of the session 2 quiz that you just completed as a part of today's course load. So I will see you again at the beginning of session 4. Bye-bye.